What started out as a market rally in Asia, and particularly in Hong Kong and China, has now pushed stocks higher across the globe. Hong Kong did also join in, I might add. The Dow in New York is climbing more than 300 points, despite rising COVID cases over the holiday weekend. But the market seems to have been able to brush off much of that. China has gained, stirring as the bullish global sentiment. Mainland China, Hong Kong, they're all showing excellent gains. And the Shanghai Composite led all the Asian markets high. It's interesting, it's worth noting, if you look at Southeast Asia, ASEAN markets, such as, for example, Malaysia and similar countries, they are also seeing EPS, earning per shares, very much higher than the general trend, 25 and 30. Kristina Hooper is the Chief Global Strategist of Invesco. She joins me now. Let's just pass this down, first of all, we'll start with China, and if you like, we'll work through the region and into the United States. China's gains are based basically on optimism, but optimism of what?
Well, there's certainly optimism around economic activity. We've seen a very significant improvement over the last several months. Now, we've seen that in the U.S. as well, but what's different about China is that they've actually been able to bend that curve. They've controlled the virus. So it's a different kind of scenario than in the U.S. And of course, China also got that nice boost from state media suggesting or urging Chinese households to invest in Chinese equities.
So China, I guess, to understand this, are those gains in China, are they well-based? Because it's well known that the Chinese government is not averse to manipulating the market one way or the other when it seems the right moment. And same with, to a certain extent, economic data. So are you satisfied that the Chinese gains are real ones?
I am satisfied for the most part, given that the fundamentals are better than the last time we saw that kind of significant rally that was goosed by China encouraging investment. Back then, we saw more leverage and we saw higher valuations. So this is on a more solid foundation this time, which suggests it has legs.
Take this to the United States. And the sort of market that we have seen, the ebullience. Now, I can understand how we make up a lot of the losses since the March lows, but it's this difficult period now where we're no longer recouping that which was lost, but now we're making fresh gains. And there doesn't seem to be the economic fundamentals to truly justify the gains we're seeing.
Well, we certainly have seen an improvement in economic activity. The concern is that that could be quite fleeting, given that we haven't been able to control the spread of the virus in many parts of the United States. We also are flying somewhat blind in that so many companies, almost 40% of the companies in the S&P 500, have dispensed with earnings guidance this year. So it makes for a situation of significant uncertainty.
Right, but I guess, you know, Goldman is now saying it expects lower growth this year. Citi overnight in its note said basically it expects the market to trade sideways for the next few months into 2021. Where is your view on the market between now and, say, I don't know, end of year, spring of next?
Well, I do believe the big gains are behind us for this year. I would expect a scenario where over the next few months, we have significant volatility. We could see a substantial pullback, but I would actually expect the stock market to end a bit higher by year end than where we are today. And a lot of that is because I think there is an upward bias built into stocks because of Fed policy. State media in China might be encouraging households to invest, but in the U.S., we're a bit more subtle. The Fed just gets more accommodative.
Good to have you. Thank you.